Good morning, everybody. My name is Herman Anning, and I'm your host for this today's webinars of RSM on managing tax integrity risks at corporate service provider. We are having almost 75 guests today in this webinar, so there is a lot of interest, and we look forward in having offering a nice program to you. Please, I would like to ask you to keep an eye on the house rules, to turn off your cameras and put your sound on mute. And if you have any questions during the presentation, you can address them via the chat box, which you will find in the middle of your screen, and address them to me. This webinar is the kickoff of actually a series of quarterly webinars for corporate service providers that we plan to give in the future. And a copy of today's presentation will be shared with you. Now, I'm going to the agenda. One moment, please. Yes. So today we will look at several topics. I will kick off with the introduction part, which will take almost 5 minutes. Then I will give the floor to Eike van der Staaij, who will elaborate on regulatory landscape and the aspects that are expected by the regulator. Then Mario van der Broek will look at the issues from a tax regulatory perspective. Then I will talk about the implementation of the regulatory requirements into the tax integrity risk management. And then Jaap will conclude with 3 case studies. And in the end of the session, we will have the opportunity for you to ask questions. And as I said, please drop your questions during the webinar. We will collect them and make a selection and answer to them. I have a little bit very nervous system, so I will go back to the, here is the agenda. Sorry for that. So first, a small introduction of RSM, who we are. Excuse me, can the person that has the microphone not on mute, put it on mute, please? Thank you. So RSM is a worldwide network of specialized audit and tax and consultancy. And our team, RSM Netherlands Consultancy, is specialized in advising and assurance assignments. We are specialized in supporting financial institutions and corporate service providers with compliance and financial supervision regulations, as well as anti-money laundering, sanction regulation, corruption and bribery, and also tax integrity and other areas of preventing financial economic crime. And next to that, we are active in other sectors dealing with international trade compliance, such as the aerospace and defense, oil and gas, logistics, and manufacturers and traders. Our team members, they are seasoned as well as very practical consultants. They have their background in financial institutions as board members, and some of our colleagues are former supervisors of the Dutch Central Bank. And in 2019, RSM started cooperating with Signum Consultancy, Eike van der Staaij, in executing the audit function with corporate service providers. And within RSM at the moment, we have several initiatives to support multinationals and financial institutions in the recent developments on the international tax regulations and on tax integrity. This is just a small overview. We are present in 120 countries, and from the Netherlands we cooperate intensively with our colleagues in the US and Asia, also on the topics of financial supervisory regulations as well as tax integrity. I will introduce the speakers in short to you, starting with myself. I have over 25 years of experience in the financial sector. I worked with the Dutch Central Bank for 5 years, and before that I was head of internal audit and compliance with Garantie International, and I started my career at Ernst & Young in the external audit. I also am the chair of the trade compliance platform of the Dutch Industry of Defense and Security, participating with the Institute for Financial Crime, and I'm the chair of the compliance working group within FCI. Eike, I think she is well known to most of you. Eike has a massive and long career in international corporate advisory and legal services with PwC for many years. Eike and I are former colleagues of the Dutch Central Bank, so this is how we know each other. And Eike is advising and conducting audits in the trust sector for several years now with her firm, Signum Consultancy. Mario is a tax partner with RSM, and Mario has a lot of experience with trust offices as well, based on his earlier activities. He heads the international service practice, and he is the innovation ambassador of RSM. Which means that he is leading major transition projects with clients of RSM, both in the corporate sector and other sectors. Jaap has extensive experience as CFO and CFRO and CEO with financial institutions. And he has acted closely with external regulators and supervisors. And he also has a long career in finance with banks, as well as Philips and Ministry of Finance. So these are today's speakers. And I hope you will enjoy their presentations. So why is this webinar, and what is actually the challenge of the corporate service providers nowadays? And you may have noticed that the last decade there are dramatic changes in the world economy and the political scene due to the financial crisis in 2008, geopolitical developments, and lately COVID-19. And that has led to a worldwide cooperation to combat tax evasion and tax avoidance, to stop base erosion and profit shifting, and to increase transparency. And several initiatives in OECD and EU have been developed and have been implemented in also our Dutch tax legislation. This also led to quite intense regulatory and supervisory authorities' actions to avoid corporate service providers' involvement in facilitating clients and structures with respect to tax evasion and tax avoidance, particularly after the Parliamentary Investigation Inquiry Committee. So today is about how can corporate service providers give meaningful content to tax integrity, taking into account all the changes in the regulatory environment, WTT, and expectations of DNB. So the first speaker will be Eike. So I give The microphone to Eike.
Thank you, Herman. Next slide, please. Mario, next slide, please. Yeah. Well, is tax integrity new for CSPs? It's definitely not a new topic for trust officers or corporate services providers, as I will call them from now. For many years, CSP have an important role in the prevention of tax evasion and tax avoidance because of the nature of the services they render to cross-border, often tax-driven structures and so-called asset protecting structures, and due to their role as gatekeeper of the financial sector. From CSPs, even a greater effort is expected than from other gatekeepers, such as lawyers and tax advisors. Since 2015, the supervisor, the Dutch Central Bank, DNB, carried out several investigations at CSP on tax integrity risk in the context of themes like the ZIRA. In 2019, DNB conducted a theme investigation, tax integrity risks, with focus on the existing tax integrity risk and control framework of CSPs, including aggressive tax planning. The results of these investigations and the expectation in this area of DNB were communicated by DNB in several newsletters for CSPs. What is new is the rapid succession of developments since the Panama Papers and the Paradise Papers, which have radically changed the landscape. Society's tolerance of tax avoidance is decreasing and has led to tighter regulations to curb tax avoidance. Examples are the OECD CRS and the BEPS action points, the Anti-Tax Avoidance Directive, ATAD, and the recommendation on tax integrity risk by the FATF. As of today, the mandatory disclosure directive, TAXES, imposes a duty to report potentially aggressive international structures and provides hallmarks for identifying such structures. Mario and Herman will elaborate on the changed tax landscape and the consequences for CSP later. In our country, a lot of commotion was caused by the Parliamentary Inquiry Committee on Fiscal Constructions and its report paper Reality. And last but not least, on January 1, the new WTT Trust Officer Supervision Act, WTT 18, replaced the existing WTT, resulting in new and stricter rules for CSPs. Next slide, please. The legal basis for the obligation to manage tax integrity risks is in the definition of integrity risk and the obligation to manage these risks in the WTT 2018. Here on screen, you see the definition of integrity risk, which, by the way, has not changed since 2014. Briefly summarized, the provision reads as the risk of being involved in acts contrary to the law and acts which, under unwritten law, are regarded as socially unacceptable and which may damage the confidence in the trust office or the financial markets. Relevant for the interpretation of the legal requirements and DNB's expectations are the good practices integrity risks for clients of trust offices published by DNB in September 2019. Helpful is also the tax integrity guideline published by Holland Questor, final version of last February. Other DNB guidance documents relevant for today's topics are, for example, the Good Practices Integrity Risk Appetite 2017, the CIRA Guidance Integrity Risk Analysis More Where Necessary and Less Where Possible 2015, and the Good Practices Transaction Monitoring for Trust Offices 2017. What is the challenge? If you look at the diagram in DNB's Good Practices Tax Integrity Risks, the challenge for CSPs is in the blurry parts, and in particularly the part between avoidance and optimization. This part is about identifying structures which are in principle in accordance with the letter of the law, but contrary to the spirit of the law and the intention of the legislator, and which should be regarded as aggressive tax planning. CSPs are expected to take a position and to have an opinion on when a structure should be considered legal but harmful, given current views on tax avoidance. They are expected to have an integrity risk appetite. The risk here, if you look at the definition of integrity risk, is conflict with what is considered socially acceptable. On the client level, this requires proper investigation and sound judgment on questions like what exactly is happening in the structure from a tax integrity point of view. Is this socially acceptable? Is rendering services to the structure within our risk appetite? The concept of tax evasion, I trust, needs no further explanation. Tax evasion is punishable and will usually also qualify as money laundering. The risk here, if you look at the definition, is clear. It's conflicting with the law. And this is a risk that cannot be mitigated and is never acceptable. On a client level, this requires that CSPs investigate and assess that taxes are paid as required in the jurisdictions involved. What is expected from CSPs? As mentioned earlier, from CSPs, greater effort is expected than from other gatekeepers. DNB's expectations of CSPs include at least the list on screen, such as they should have a specific tax integrity risk appetite as part of the generic integrity risk appetite, specifying which type of clients and structures and which forms of tax avoidance the CSP considered acceptable and unacceptable. They also are expected to include a tax integrity risk as a specific risk category in the SIRA. They also have to include tax integrity risks of the entire structure, so not only of the objects company, the entire structure as a specific part of the risk assessment on the client level. And they are expected to have sufficient tax knowledge to assess the quality and current validity of tax advices and opinions of third parties, and to accept only clients and structures if the trust office can oversee and adequately control the tax integrity risks involved. So far. Later, Mario will elaborate on the tax angle, how to manage the changing tax landscape and the relevant tax issues to address in the new context. Herman will discuss how to implement tax integrity in your sound and controlled operational management and actions to take leading to an effective control of fiscal integrity risks.
Hi, thank you very much. This is Mario van der Beek speaking. Now, my background is, of course, from an international tax perspective. I've been working very closely with Eike and Jaap and Herman in the last 6 months about integrating the regulatory perspective with the tax angle. And of course, if we look at the last, let's say, 7 to 10 years, you know, the tax landscape has changed dramatically. Of course, because of BEPS, but following BEPS, basically because of the public opinion and increasing transparency. Now, and as most of you on this call know, tax advisors work very closely with corporate service providers. On the one hand, tax advisors had a designing role and also sometimes a mandating role, and of course corporate service providers an executing role and a monitoring role. What's very important in the last especially 3 years, because of the increased transparency and scrutiny by the public opinion, we're also faced with a changing dynamic on what is acceptable and what is allowed. And Eike also elaborated on that between tax evasion and tax avoidance. And I think increasingly where we find ourselves now is structures that are still allowed, but increasingly become less acceptable. So of course, you know, when Herman and we did a number of audits for corporate service providers, a lot of reference were made. Well, we had an advice from a tax advisor or a reputable tax advisor, so it must be okay. And I think that especially under the guidance of the Dutch Central Bank, it's also important to create your own set of rules, which is based more on what is acceptable instead of what is allowed. Now, and what we are doing there is, of course, we take a look at the new tax rules. Obviously, some of the structures have been forbidden, but many structures are still allowed. But that is not the same as they are acceptable. I think a good example is, for instance, substance. There's a lot of scrutiny on the use of holding companies and their substance. And I think a lot of people in the audience are obviously part of providing sufficient substance at the level of holding companies. But more and more we see throughout Europe and also parts of the rest of the world, we see more and more that the typical substance no longer suffices. So we have to think about alternative routes. That doesn't mean a holding company is no longer allowed, but you have to think about ways, when is it acceptable? Maybe in the form of a fully operational headquarters, maybe it's a different role for a corporate service provider, but in any case, whenever you decide to accept such old structures, you have to think about, you know, what kind of values, what kinds of tax norms have you created. So it's very important to take a look at, of course, the case studies that are around. Of course, we look at the mandatory disclosure directive, but even with the mandatory disclosure directive, with some label as, you know, aggressive tax structures, those tax structures, even if you have to report them, they would still be acceptable, which is not always the same as being allowed. Now, this is a quick overview of what you have to deal with as an international company. And I think also if you are a director of such an international company on the seat of the corporate service provider. So not only are there new rules around transparency, but certainly new rules around digital taxation, BEPS 2.0, of course, Brexit, the Corona crisis. So it becomes very dynamic and a very mixture of regulatory, tax regulations, and what is allowed and what is acceptable. So that's a very big challenge in front of us. Now, I think that what's very important for us, and I will let Herman talk a little bit about this in more detail, but what we have done at RSM is we have, you know, integrated, you know, the tax regulatory side with the regulatory side, especially highlighted by Eike and to be highlighted by Jaap and Herman. But it's very important that we create a set of guidance, a set of rules, influenced by the new tax rules, which is not just something that you say, well, it is acceptable or it is written in a tax advice. There is more to that. I just wanted to leave you guys, and Herman will go into that a little bit more detail, We cannot go around making some comments on the DAX 6, of course, because like I just said, it is one of the guiding rules to find out what is aggressive or not. It's certainly not the only one. We also have to look at the changing rules, but especially we have to look at the changing mindset of internationally active companies. I think we've seen in the UK already where they have the anti-tax evasion rules, where companies have to train their people, where you have to do internal risk assessments. So this is just another step towards creating a new set of rules to determine what is acceptable and what is allowed, or what is evasion, or what is avoidance. I think the latest and greatest is, of course, that the Netherlands, like many other countries in the European Union, have provided for an extension of the deadlines. But in our views, yes, that seems to hint towards extra time to get ready. But you also have to understand that there will be a second reference period where you have to take a look. So the first reference period stays alive, and there's a second reference period that is even longer. But with that said, Herman, I would like to hand over the slides back to you.
Thanks, Mario. As said, I will discuss more about the implementation of tax integrity in the sound and controlled operational management. And actually this overview shows all the relevant elements that are depicted into the WTT. And actually the measures that are expected could be divided on, let's say, the organizational level of the corporate service provider, and those that should be applied to, let's say, the individual client or the level of the object company. And actually the thinking about how to organize yourself starts actually at the lower left, the tax risk profile of clients. And this is actually what DNB expects corporate service providers to apply and to execute. It's mentioned in their good practices. And that means that for every client you draw up, as it says, the tax risk profile where you identify relevant tax integrity risk indicators. And actually when combining all these risk profiles of the clients, you go to the top left, you actually have the good basis in order to perform the impact analysis of tax integrity risks for the whole client portfolio and all the trust services that you provide. And this is normally called the organizational profile of the trust company. And this is an important base for subsequently doing the CIRA, identifying integrity risks, but also identifying the relevant control measures that need to be in place in order to mitigate the risks within the risk appetite. And that's next to the CIRA. It is expected that you have an integrity risk appetite statement. And in this statement, you are expected to be very clear on what you think is acceptable or not acceptable from a tax integrity perspective. And this is not a theoretical exercise, and this is not, let's say, information that you Google, but this really has to be customized to your own situation, your own client portfolio. And there should be a close interaction between the risks that you identify and, let's say, the risk appetite that you have. And sometimes in practice, we see that this is lacking behind expectations. Next step is defining a proper tax integrity risk policy, in which you kind of put the strategy on how you're going to mitigate tax integrity risks. And in this policy, you also give a definition or your own meaning to tax avoidance or aggressive tax planning, as well as tax optimization. And you do that based on, let's say, the client portfolio that you have. As of the 1st of January, there is also a policy rule of DNB regarding what is socially acceptable, maatschappelijke betamelijkheid. And the tax integrity risk policy is closely related to that. But it is expected that tax integrity risks are explicitly covered in a policy, and that policy decisions are taken. Now, the CIRA risk appetite and the policy, it is expected they are translated into, let's say, the measures that are being taken at the level of the individual client and the object company. And I pictured here the elements that are mentioned in the WTT, but also in practice, DNB expects explicit documentation and instruments covering client investigation, the integrity risk analysis at client level, and also, let's say, the ongoing due diligence on the client relationship, the transaction monitoring. And actually, the acceptance memorandum is expected to be a kind of an overarching analysis, capturing the outcome of risk analysis, client investigation, and transaction monitoring. It's our experience that sometimes improvements must be made in this area. Some things to point out that in the client investigation, the purpose of the structure and the object company should be clearly analyzed and assessed, and also should be related to the purpose of the trust services. And overall, the corporate service provider should assess whether adequate risk mitigating measures have been taken in order to cover that risk. I also want to point out your attention to Article 35 of the WTT, which requires you to look more careful into complex or unusual large transactions, which is called the enhanced due diligence. So that means that for particular intercompany transactions or dividend payments or capital movements, special investigation needs to be in place. And another development is the consultation of the WTT, which among others, it is proposed to prohibit services to clients, UBOs, or structures that involve high-risk third countries or low-tax, non-cooperative jurisdictions. So this is, let's say, the overall picture of the elements that should be there and, let's say, the interrelationship between those elements. So none of the elements can be approached in silo, as it were. So what does it mean? What does it mean with respect to the international tax measures and that are currently taking place, but also, let's say, the good practices published by DNB and Holland Questor? It's important to take good notice of that. And Mario already mentioned one of the examples for coming from the European Anti-Tax Avoidance Directive, which is about making use of international tax treaties and how your clients can get access to those tax treaties. And nowadays, additional requirements are put, such as additional operational substance, but also an explicit principal purpose test to see whether the structure meets the economic and business reality. So what does this mean? That means that DAX 6, this will have consequences for the corporate service providers because they may be seen as intermediary, which will trigger a reporting obligation. And this is coming towards you in the short term. And on the other hand, DAX 6 is acknowledged to contain hallmarks that indicate tax integrity risks. So that means that the hallmarks should be taken into account and should be part of the risk indicators that you define in order to investigate your client portfolio and your trust services. And again, as I said, the tax risk profile of the clients, that is a key element, let's say, in assessing the impact of tax regulations. And you may face several dilemmas in this respect. The failure to report aggressive tax structures under DAC 6 that meet the hallmarks may result in the investigation and enforcement by tax authorities. And unduly reporting of a non-aggressive structure may impact the client and the corporate service provisioning, and may lead to legal liability for you as performing as a director. On the other hand, all the developments regarding tax aggressiveness, etc., is still under development, and there is a lot of differences in interpretation already in Europe with respect to the member states. So that means that you have to keep track of these developments and constantly have to assess what the impact is of these developments on your client relationships, and whether you can provide your trust services ongoingly. And also your clients may respond to these developments in different ways. They may adapt their deemed tax aggressive structures, or they might be motivated to create additional artificial solutions, which increases tax integrity risks. So a lot of challenges coming ahead of you. So what's the level playing field that you're in as a corporate service provider? Actually, you as a corporate service provider, it is expected that you take your own responsibility. And because you're subject to the WTT, you're not only looking at whether the structure of your client is compliant, but you should also look at the integrity aspect of it. So your focus is also on the structure. Is it not only legal, but could it be harmful? And you should give your own meaning to what you think is tax avoidance and aggressive tax planning and tax optimization. And you need to have that position by yourself. And as I said, your policies and procedures should make this explicit. And on the other hand, the tax opinion of, let's say, your client's tax advisor is a very important instrument in order for you to check the purpose of the structure, and also, let's say, the context of the services that you provide. But still, you are expected to have an independent opinion about the tax opinion as well. And it is expected from you that you also take into account the nature and background of the tax advisor, whether it is an ethical party and credible. And you should also look at the scope and the depth of the tax opinion, of course. And in practice, we often run into tax opinions that are not actual anymore, maybe older than 3-4 years, which then actually are not capturing the actual situation. And you also have to take into account that your client or the UBO that you're servicing and the tax advisor may have different interests than you have. But as we said, the developments in the international regulations, but also, let's say, the public opinion, also regarding tax avoidance, give the trend that also, let's say, corporate clients and tax advisors move more on the line towards tax integrity. And as an example, the Ministry of Finance addressed the social responsibility of tax advisors earlier this year. So this is a convergence, in my opinion, of the standards that are about to happen. As I said, the corporate service provider is expected to give meaning to tax integrity risk in the CRA risk appetite, tax integrity risk policy, and the procedures handbook. So that means that you have to give your own meaning about what is tax avoidance or what is tax optimization. And actually there is no clear definition available in the law that is still under development. So that means you have to do it yourself, looking at your client portfolio. But what does it mean, giving meaning to tax integrity? And that means that all the relevant regulations and standards regarding tax integrity and, let's say, the underlying indicators, you should identify them. And you should have your own vision and perhaps your own principles on tax integrity. What is allowable, what is not allowable, and what is your perception of that? And also, let's say, having a good understanding of your client portfolio and the risk profile is important and expected from you to have that ready and available as a good basis for the CIRA and, let's say, further on the policy and procedures and measures. And finally, the acceptance memorandum is an important instrument to make explicit your considerations and also to justify the acceptance of your client. Sorry for this slight interruption. So if we share some of our lessons learned and experiences that we faced in practice, we have seen insufficient depth analysis of client portfolios, resulting in insufficient identification of tax integrity risks and too generic tax risk scenarios. Also, risk appetite often seems to be defined too generic and not addressing concrete tax integrity risk circumstances. And sometimes the risk appetite only excludes tax evasion and seemingly allow for tax avoidance. And this is not accepted by DNB. And one other issue I want to point out is that investigating the client's tax motives and goal and purposes of the client structure and the object company, as well as the objective of the trust services, that is key. These need to be investigated, interpreted, and substantiated and documented. Otherwise, DNB might conclude that you have an insufficient base to sustain your client relationships. I'm coming to my last slide about the tax integrity audit. Mario? Or... Thank you. So tax integrity audit may help you in arriving at a more effective operational management. Here we pictured our two lanes approach. First lane focusing on the tax integrity aspects of the structure, and second one on the effective embedment of the tax integrity into your internal organization. And you can do this in phases, starting with sharing knowledge and creating awareness, doing an impact analysis on your client portfolio, do a gap analysis on your measures, and follow up closely on remediation and the implementation of newly measures. So now I hand over to Jaap. We'll talk about practical case studies in order to give you some idea how tax integrity risks may affect you. Yeah, over to you.
To take over. Of course, we all had to, let's say, absorb, digest a lot of information, but in the end, it all boils down to assessing transactions, whether they are eligible in line with the risk appetite you as a trust company have formulated. And I've selected three cases which, for the sake of client confidentiality, I anonymized and changed a bit, but the challenge is realistic, as you may encounter in the market. And now just let me go over them and share my views. In the first place, I will share with you a simple structure. Why? Because in many cases we see that people associate aggressive tax planning with complex structures. So this is why I start with a simple case. In this case, you see two UBOs, one coming from Turkey and one coming from the United Arab Emirates. They've decided to establish a company A in the Netherlands, which is served by a corporate service provider. And this company A has established a company AA on the British Virgin Islands. Now, given all the hallmarks and the red flags list we have seen, of course, this is a high attention case. And the first question obviously is, what is company AA doing? Now, of course, when I looked at the case, you find out that company AA owns a ship, which is located on the British Virgin Islands. And it's a leisure ship, and the both UBOs every now and then go to the Caribbean to use the ship. So nothing spectacular. But in design, of course, this structure could be misused. And so the question is, what transactions would you expect to occur to let's say, run this ship in the BVI? Well, in the transaction profile, it turned out there are no spectacular plans. It's really all about using this boat for pleasure. But of course, the boat needs fuel. It needs a captain that takes care of the ship, that has a salary. The boat needs fuel. You need to pay ship registry fees. So the purpose and the nature that was expressed by the UBOs in Company A was just to do this kinds of transaction and no any, let's say, not any aggressive tax intentions whatsoever. Now, then the reason is, why would these two UBOs establish a Company A in the Netherlands? Why not in another country or whatever? Now, that has to do with some general, let's say, advantages of establishing companies in the Netherlands, stable climate. You all know the reasons. So in this context, you could conclude it might be feasible, but you also have to be alert, of course, on the risks of such a structure, because if transactions would fall out of the scope of the expected transaction pattern, just to mention an example, if all of a sudden this entity on BVI start charging or sending invoices to Company A for consultancy services or whatever, then you are entering into dangerous territory, because then the design could be, let's say, used for aggressive tax planning or even tax evasion. The substance question was addressed by Mario. It's clear this company has little substance. It obviously meets the minimum requirements, and in itself, that's not a major problem. It's an attention point, it's an alert, certainly. But as long as, let's say, the taxation follows the activities, it can be acceptable depending on your assessment. Now, maybe now scenario 2, this is just a different perspective I offer that may impact your thinking and your assessment about this situation. You see still the same structure, but now we also see that the two UBOs via Company A have two operating companies who are active in automotive parts manufacturing, and one is located in Russia and one is located in Hungary. Now, how does this alter the assessment? You could say that let's say, the business rationale for setting up a holding company in the Netherlands may be a bit more easy to explain for business reasons. It's pretty common that if you have international operations across the globe, that you find a location to set up a holding company. Now, in this case, that could be the Netherlands. But at the same time, the transaction becomes more risky, because yeah, you cannot exclude that there will be intergroup payments between company AA3, AA2, and AA1. So again, this could be an eligible structure, but more than in the first scenario, if you were to support company A by providing the services, the responsibility for adequately monitoring the transactions, the intergroup transactions, is high. If a transaction were to occur, or you were to see it that really falls out the expected pattern, you really have to dig into it immediately and maybe have to conclude that a reporting to the FIU is needed. Now then, I have a case which in a way is also simple, but it is multi-layered, and multi-layered structures are also commonly perceived as being potentially aggressive. And this is about a set of companies established in the Netherlands. As you can see, company A, there is a B fee and an N fee. And in this case, there are UBOs coming from Kyrgyzstan, and the structure does raise questions, of course, if ultimately the company that is operational is in Kyrgyzstan, what does it do? Well, in this case, first a remark on the UBO, because that's also from a tax aggressiveness point or evasion point and tension point. It only owns 2%. Still, in this case, it was considered a PEP because of relationships, and there was adverse media which showed allegations on corruption. So again, a high risk element added to the equation. Now, what does LLP do? LLP had a business which was entirely in Kyrgyzstan. The company owns real estate and equipment and leases it out to third parties. And now this is the business model. So the question is this eligible? Is this tax aggressive or not? Maybe not at first glance, because all the activities take place in Kyrgyzstan. All the taxes are paid in Kyrgyzstan. I always look at the angle, is any tax authority disadvantaged by a structure? Well, I would say not immediately, but in this case, I saw a tax opinion that mentioned the establishment had to do with the potential future divestment of the company, which would result in exemption from paying tax over the capital gains. So in that case, yeah, I can only see a tax motivation. I see no business rationale for being here. Sometimes asset protection is a business reason that could be acceptable, but I don't see the protection of the asset in this case. So from my perspective, this is in a way also a simple structure, even though it's multi-layered. The multi-layering, of course, does also raise eyebrows. Mostly these multi-layers are used to, let's say, promote client anonymity. Well, in this case, the UBOs were known, in any case, to the corporate service provider. But for me, in today's, let's say, environment where you look at the sort of main benefit test, is it predominantly made for gaining a tax advantage, or is there a business rationale behind it? I have difficulties in this case to see the business rationale. Now then, yeah, the holding structure was mentioned. As Mario already addressed, holding structures are in principle, even in the new circumstances, acceptable. But of course, as always, you have to look very well at the rationale behind it. In this case, I will show you a somewhat more complex structure with many jurisdictions involved. It's about one UBO in Turkey, a UBO family in Turkey, and a UBO in Russia, who have jointly set up two companies, both located in Turkey. And the ownerships are as follows. UBO 1 has 28, UBO 2 has 30%. But it's more likely that UBO1 has control over his family and is the dominant UBO, but in any case, both are UBOs. And the question here, of course, is what is the function of these both companies? Now, company B is a holding company, and let me see, I'll lose my control over the slide screen now. Yeah, back again. Company B has established a company BV in the Netherlands, and this company BV is serviced by a trust company. And company A has two local operational companies in Turkey. Now, the reason for establishing the company in the Netherlands was related to the tax treaty between company B and company BV. So clearly, in any case, as mostly is the case, there is a tax rationale. So the question now is, what is dominant, the tax rationale or is there a business rationale? Now, the question then, of course, is what is the purpose of company BV? In this case, the company is active in international logistics globally. So they own a number of ships, and these ships are registered in 3 jurisdictions, being Marshall Islands, Isle of Man, and Malta. Now, in this case, we know that the ships that travel the world have to be registered somewhere. These locations, just like BVI, by the way, in the first case, are known for their reliability in ship registration. It is a common practice in the market. So from looking at the whole picture and let's say the business rationale, it could be an acceptable structure that is not necessarily tax aggressive. But also in this case, of course, one needs to carefully look at the expected transaction and whether indeed in reality all the transactions are in line with such a portfolio. So company BV may act as, let's say, the treasury function. It may provide the equity to the companies in these countries, for which in turn it will receive dividends. So these are, let's say, the challenges looking at this structure. As it happened to be the case, there was one question posed by the chat, which I happened to see, and the question was like, do we only need to look at the entities that are in the column that you as a corporate service provider are servicing? So that would be the subsidiaries and the top entities up to the parent, or should you also include sister companies in the equation? And my answer is it depends. If company A were to be entirely separated from company B with no interlinkages, shared services or intra-group transactions, I would say maybe a high-level glance could suffice. But as soon as there would be intercompany relations, particularly if it were from those entities to the shipping companies, then you enter into the mode again, like a risk of, for instance, profit shifting. So by all means, you always have to look at the column and all the entities in the column from the UBO to the subsidiaries. But depending on the situation, it could be expected to also form an opinion on sister companies. This was, let's say, what I had to share with you in terms of how to look at structures. It's not always black and white. Eike already mentioned it. It takes a judgment call. Even though there are many red flags and hallmarks, they are not quantitative that you could put them in a tool and run the engine and a black or white outcome comes from the tool. You have to think about it and use a sound judgment. And in the last case, I want to add, I have some background in having studied tax, but I would ask for a tax opinion in such a case where you may have doubts and really want to have an expert opinion on the structures behind it. Thank you.
Thank you, Jaap, for the last part of the webinar. So we are going towards the end and the wrap up. As promised, we will also look into the questions being asked. We have received several questions. So if you can bear with me for 5 more minutes, that would be nice. First question relates to the structure of the client and whether this structure also should include sister companies or only the structure in a straight line. And actually this...
I more or less just addressed it.
Yeah, and I think the explanation to the WTT on what entails a relevant structure, I think is very clear, which is also including sister companies, but also, let's say, companies in which the object company has control or ownership, but also, let's say, entities within the structure that may pose an integrity risk to the trust services or related to the object company itself. So yeah, that should be perceived broadly. And just one aspect I would like to add, that it is expected that you are able to explain every part of that structure and the reason for being it as it is, such as why is this structure structured via the Netherlands, for example, or what is the meaning of particular entities being located in offshore jurisdictions or in companies like Cyprus or Malta, where you can buy your residency. Another question that came in is when do the responsibilities with respect to tax integrity risks come into play? Well, actually, DNB already expects you to identify potential tax integrity risks and take proper risk mitigating measures. Perhaps, Mario, you could elaborate a little bit more on the DAC 6 responsibilities for corporate service providers.
Well, I think that, well, we don't have any time anymore, but I would suggest that we set up a quick call to discuss that. But basically, you know, if you are actively involved in setting up and designing a structure, those regulations also apply to you. And we are now very busy with a lot of our clients to do risk assessments because regardless of the extension, I think it hit home pretty hard that DAC 6 is not going away despite the extension due to COVID. I think it's very important to understand that it's not going away. I think several countries already expressed their desire to use DAC 6 as a way of a revenue generator. So I think it's very important to understand the impact of DAC 6, but even so the importance and relevance of this message of tax integrity that even exceeds the importance of DAC 6. So it's not just about is it allowed, but also is it acceptable? And that is something you have to work with together with your clients, help them get educated.
Thanks, Mario. One last question, talking about acceptable or not. Jaap, we received a question about, let's say, the second example that you provided. What do you think? Is it acceptable or not?
No, I leave judgment to others, but I expressed my opinion that I don't think it is acceptable under today's circumstances, because if you do some sort of main benefit test, in the end, it's about is the structure predominantly there for tax reasons, so gaining tax advantages, or for a business reason. I just failed to see any business reason there. So at the moment, maybe the tax consequences may be limited, but the analysis was that the only reason to be in the Netherlands was to, in the end, if at some point the company were to be divested, to gain an advantage in avoiding capital gains tax. So legally it was acceptable at the time, but I think in today's standards on what is perceived as aggressive, I would say this is aggressive. So that would be my judgment call in this case.
Okay, thanks, Jaap. One last question and then I will wrap up. That's a question regarding holding company. What would entail acceptable economic substance? To have an office and one director, is that already sufficient? And let's say we are looking at a asset holder company in a group of companies. Mario, could you reflect a little bit more on the economic substance part in that respect? What would entail sufficient substance? Are there any practical aspects?
I think it depends a little bit on who you talk to. Maybe I am not the right person to talk to, because I think that you need to have more substance nowadays. I know that people still cling on to the minimum requirements issued by the Dutch Ministry of Finance. But I think that if you look at countries like Italy and Spain and even countries like Germany, they really look at, you know, the experience of the managerial activities, the strategic activities. So yeah, I wouldn't talk about minimum. I would really talk about the role that the holding company plays within the entire organization. And I think that if you are a cross-border operating corporate service provider, the benefit is that you may have alternatives in other countries where they do have more operational substance. So I think there could be a minimum where you can get away with it as per today, but hopefully, you know, we were able to leave a message of that is no longer acceptable and you have to do more in the nearby future. So hopefully for now, that's enough, but happy to go into much more detail, Herman, at a later stage.
Okay. Well, thank you, Mario. Thank you, Jaap and Eike, for your presentations. Just a quick wrap up from my side. Eike talked about the challenge with respect to tax integrity and to understand the difference between tax avoidance and, on the one hand, tax optimization, and on the other hand, tax evasion. You need to understand yourself what is the meaning of that. Mario emphasized that corporate service providers are expected to define what is acceptable instead of what is allowable. And I myself wanted to give you a picture of what it means when it comes to implementation of tax integrity. And provided some insight in some cases that were maybe unacceptable on the one hand and maybe on the other hand acceptable. So we thank you for your attendance to this webinar. If you have any questions or you would like to raise any issue, you will find our contact details in the presentation. As I said, this is the first webinar in a series, and we are planning to do so every quarter. So may I invite you, if you have any topics you would like to discuss further, to drop us an email. Then for now, I would say have a nice day. If you go on holiday, safe travels and stay safe. Thank you very much.